Good morning, good afternoon, and good evening, everybody. Hey, welcome to this episode of the Note Closure Show. As always, Scott Carson, excited to be here today, and I am extremely jacked for this episode. And you guys that follow me know that we've been really kind of highlighting some of our socials, some of these different apartment syndications that are failing, or these big apartment complexes that are going south. And being in the distressed debt space for 20 years, you've seen some good, some bad, some downright ugly stuff taking place not only in the residential debt, but also in the commercial side of the ball game. And our special guest today is just a phenomenal guy who is going to share some interesting things he sees out there with some of these big multifamily syndication stuff like that. I had a friend the other day mention on Facebook that she's a part of like 15 different multifamily syndications, and only two are paying out right now at all. The rest of them are all not paying or going the route of foreclosure. And especially within Harris County, this month alone, there's 12 big apartment complexes going south that have all been bought in the last year or two. It's a pretty bad time. So my special guest today is somebody who focuses on that side of the business and outlining the fraud, because not only is a former businessman and preacher, he's also a convicted felon who's got an interesting story to talk about today. So who am I talking about? I'm talking about my buddy Barry Minkow here, joining us today on the Note Closure Show. How's it going today, Barry?
Scott, honor and privilege to be on the program. Love what you do, and could not think of a better um, timing for what you said. Just take your last point, where so here's what I would love for everybody in your audience to do to realize the value that you bring. And the reason I reached out to you, as you know, because I just love what you're doing in terms of educating um, the just with facts. I mean, you are just a straight shooter. It's like here's a building, and it's cumulative and it's
Mhm.
undeniable, and you're not emotional. You're not one side or the other. Fact after fact of troubled and distressed buildings, certainly something we don't want to see. But let me just ask you this question. Do you know what the social media public company quarterly revenue for Meta was for advertising? What component of that was Reg D, multifamily, real estate, and or promissory note advertisers on social media between the platforms of Meta and Instagram? It's a public record in a 10K, most recent. And I think you ought to have a look because there's something wrong here. You said that a lady with 15 deals is only being paid in two.
Mhm.
You wouldn't know that by the advertising promises of these Reg D promoters that normally and regularly, as a manner of practice, when they know the opposite to be the case, this is where fraud is, they know it not to be true. And you say, well, how could you make such a statement? Well, you can make such a statement not because it's my opinion, but because I have a calculator and I can go to the public record and look at a New York based $2.8 billion in quotes company. And even if I just give them those values, they're at 90% LTVs. But when you do CoStar and Reonomy and sub market book value, they are over encumbered by 300 million. So at best, they're lying because they promise investors never over 80. That's material fraud because relied upon equity is critical in a deal. There's
Mhm.
no way they're ever going to earn a dime ever. Those investors, it's already gone. It's just waiting for the regulators to act because you can't get out of 2.5 billion in debt service. My only criticism of book value evaluations is that's below the line, right? Especially when you're dealing with, nobody thought that would be a problem for multifamily, Scott, but now you see LTVs like that are 140%. I mean, I'm looking at these loans and we got a case with one bank now that does it normally and regularly in the state of Indiana with a couple Reg D companies, but in this particular example you gave was brilliant. She's only being paid in two. This is called what we call inductive evidence. But you look at the social media ads, Scott. What are they telling you? I could give you 100. You see the fraud minute. We
Yep.
do it all the time. You wouldn't see that, and it's so disconcerting that somebody like me or Sammy Antar, Mike Francis, or maybe you, somebody who is got a track record of being in prison, and deservedly so in my case. If it were me running a Reg D multifamily and doing this crap, I would get life without, no question. And I ought to have. But the critical nature of what you're doing, because you're so objective, you don't give a rip about where and you got to forgive me for the background because I'm traveling, but I wouldn't miss this for the world. Honored to be on the program because of the work you're doing without even meaning to. I mean, I don't mean you don't mean to. I just think you're just giving facts and you don't really have a dog in the fight, but you do because you're literally educating people that, there's another side to this Reg D story. They have no hope because the ads don't tell them that there's the buildings are hopelessly over encumbered. There's no equity. Ergo, the debt service, book value notwithstanding, they're never going to make a dime. They're doomed by design from day one. You have investors right now and law enforcement. I get a lot of pushback on this for talking about it because they don't like you to talk about specific cases or whatever. And they don't, I don't have any special relationship or nothing like that. They just have a very one-sided view of things. You give us everything, we tell you nothing, and shut up and toe the line kind of thing. But you have a situation now. Have a think about this, Scott, for a second. The greatest accounting fraud in the history of American business. You know the numbers as well as anyone does. And you say, well, there's no financial statements. How can you have a major accounting fraud? And this is the pushback I get from the CPA firms that I speak for free to any MBA, any college or graduate level accounting as part of my restitution. I try to speak for free always to, kind of repay the industry that I harmed as a crook. But I challenge them and they say, well, there's no financial statements. And here's what I say. What is the difference between, because you know the words, you use them every day, Scott, IRR, assets, equity, leverage. Those are FASB words. Those are general accepted accounting principle words. Those are general accepting auditing standard words. They use the vernacular with no accountability, so the checkbook's a mess. If you ever get the bank statements, they all go to prison because it shows where the money really went. It's all a fraud. But getting those today, because they're afraid they're going to get sued, law enforcement, if they're wrong. But the point is that it's an accounting fraud because statements about financials relied upon by investors are no different than financial statements that are fraudulently prepared, relied upon by investors. And just because the Reg D world is exempt from independently prepared audited financial statements or reviewed or any, doesn't mean they have the freedom, Rule 10b-5 and others, to make false statements about financial information. That's why this is the largest accounting fraud. So you'll see tomorrow, 7 properties, 1 company named after a football team in Minnesota. They're in Virginia. Nobody advertises on social media more than them. They have buildings that they currently list that they don't own, not now, not ever, not in the public record, not in Reonomy, CoStar, not on loan docs, notarized, Scott, by another buyer. And the pushback law enforcement accepts is, well, co-GP. You've heard this one. You can have 82 co-GPs. Now, watch this, and then I'll let you go on this because I'd like your take. There are 82 co-GPs. They forgot about the word proportionate distribution. So if Scott and I own a building, on my balance sheet, no banker is going to believe that if I'm a GP or co-GP, that I own 100% rights to claim the IRRs or the asset. Well, right. You can go look at companies right now, and I give an example on tomorrow's Fraud Minute, where you have 2 companies. One legitimately owns the property, loan notes, notarized, public record. This is not a Barry opinion thing. The other lied, and regulators yawn because it's practice. It's the way things are. You don't get the way things are is you get to lie. Those 7 buildings, over 250 million worth of a lie. They don't own them. Now, their past performance is impacted because they're claiming the IRRs that they had no part of. And 100% of them, you code GP apologists, it's crap. They're represented by a Big Ten law firm, one of them. It's all bad. And regulators are hopelessly overwhelmed. And here we watch it and just cringe. And you are able to come out and just objectively say, before you go into this Reg D multifamily, by the way, Vanguard has 165 funds, Scott. And if you go 9 years out, not one of them matches the company that's faking the assets historical ARR returns. Brother, it's you couldn't make this up. I'm sorry for going so long.
No. That's a good point there. And here's the thing: history repeats itself. I used to say this back when I first got into buying distressed debt back in 2008. The first flush of what came across my books, Barry, was all this multifamily stuff. Distressed multifamily. People weren't able to pay their mortgage payments. They weren't able to do anything. They were in serious default. I'm like, okay, that happens. We bought some stuff at a big discount. What happened? You could look back and say that they overfinanced it. They expected to increase rents. It was all on a house of cards, basically. You know what I mean? Oh, here's what we expect to do. And everything is always the best possible outcome. It's never half-ass in the middle or even the worst.
Projections.
It's all projections. And I don't know how to budget off of projections. When I was early in my career, I worked for a chip company here in Texas for a while. And we always wanted projections for budgeting and coming up with sales. Well, projections never matched up with what the actual numbers were. They were always in a rosy. When you're seeing the president or CEO, well, let's go ahead and bump that number up because I want it to be better because it's going to look better for the stock price. I'm like, you can't run a business like that.
That's my word. That's why I did 15 years in federal prison.
We'll get to that story in a second. I don't want to take it away. But that's the thing is that I've seen this for years that when I look at things, as markets have gone up, and the multifamily space, Class A, Class B, has been the most overpriced asset class in the last 5 years. And I'm saying it does not make sense for people going and what they're paying for these things at top dollar, overpriced.
Hold on. But why is that, Scott? Hold on. This is another brilliant point, and I can't take credit for it. And one of my favorite experts who currently doesn't return my calls, I absolutely love him, Craig McCain. He's the best there is. And I used him as an expert in a case years back, and he said to me, "You did a great report, Barry. What did you miss?" I said, "Nothing." He goes, "No, you did. You forgot that they overpay." And I said, "You're right. They pay triple retail. You know why, Scott? You always, when you're running a Ponzi scheme, you have to have two things: a debt fund, and you'll notice a lot of Reg D multifamily moving into the debt fund. Now, don't confuse debt fund promissory loan note fraud with those good people that buy and sell mortgages on homes one at a time, and they're legit and they have a track record. And you can, I'm talking about funds that have no financials, no accountability. You have no control or input. So why are they so many? I can name 5 right off the top, moving from Reg D and already have moved into including the one that's named after the Minnesota football team. Why? Well, you know what? These buildings, apartments, they're hard to run. I'm getting a lot of fees with, tenants not paying. And I now know the difference between vacancy rate and economic occupancy. There's a huge difference. So you have a full building and half of them ain't going to pay because they ain't got no money. What do you got? So so I know I can raise 10, 30, 50 million in debt, promise to pay you 12%. I do that anyway. Only this time I don't have the overhead to play the float with your money to cover the Ponzi. And I could keep the plate spinning longer and pray that rising tide raises all boats. Appreciation will happen again with the new administration. It's all bad. They're moving into debt funds, not to be confused, promissory loan note funds, not to be confused with legitimate trustee buyers and sellers who are on bigger pockets and do brilliant work, and not that. But these are funds that are ruthless. They have no accountability. And I've been trying to tell law enforcement, guys, if I'm running this Ponzi scheme, these apartment buildings are a pain in the, I got to pay loans. And not, hey, but here's what happened, Scott. They ran out of the equity kite. Fighting equity. The music stopped. And at the end of 2022, the shift began where you couldn't kite equity. And what I mean by that is, hey, borrow and borrow. and just re-borrow and borrow. But when you run out of that, you got to start at that fund. Now, the other thing is interesting is, and I'm telling you, the stuff these guys get away with, it's like a suspended reality, the world of Reg D accounting. They don't sell a property. They could, it's a fan that you're going to laugh because I know you know this. Because actually, full disclosure, Scott shot holes in an argument I had on a bank deal. And I didn't use the argument because he said, look, you moron, I understand what you're saying, but it's not in the documents. You can't use it. And he was right. I had somebody else say the same thing. So you know your stuff. The issue is the deplorable tactics used to deceive with partial truths and the whole bit. But when they ran out of the ability to borrow on these properties, and some of these LTVs are post 2008 financial crisis like, and I'm like, who are these lenders? There's one property that this company that I mentioned after the Minnesota football team, they have a $139 million loan. No, hold on, right now. So you can stop watching. You can go look up the address. I'll pay you for the title report. And you'll see 140. It's not cross collateralized. I got burned on that. I had to eat humble pie with a regulator on one of those loans. Missed one. Won't let that happen again. But $80 million property at best. It's really 42 million, but they overpaid. So there's a sale price of in the title report of like 80 something, which it isn't. Then the actual price, which is in the loan docs at 76, and Reonomy, and I mean, excuse me, when you do the subcategories book value, it's about 45, 139 mil. I'll give you the 80. Who does an LTV like that in a post 2008 environment? Are you noticing that?
Well, what you have happening with that is you've a couple factors going on. Interest rates going up and things being on a floating rate schedule. That, everybody got cheap money 3-4 years ago with the idea that they were going to refinance out in 3 to 4 years before the rates changed. Well, when interest rates went up, a lot of these interest rates obviously went from 2, 3, 4% or whatever up to 8 or 10% interest rates on these loans. Well, that reduces your cash flow because it increases your debt service ratio, or reduces your ratio that increases your debt coverage costs. So now you're not able to take that extra cash, that money that you raised from investors to put into upgrading the property, increasing it, the value, making long-term maintenance requests, or putting paint on a pig to get a higher rent rate. So now you don't have that money. Well, you can't raise rents. Rents weren't going up as much as they thought they would. Everybody thought they were. They failed to realize that a lot of these apartment companies that were going out and building new apartment complexes in parts of San Antonio, Houston, other areas across the country, that's going to affect your occupancy rate, because people are going to, why would I want to live in a 1984 apartment when I can live in a 2024 apartment complex?
Oh, yeah.
So you have reduced rents, which reduces your cash flow, which reduces your NOI, which reduces your cap rate, which reduces the value tremendously, 10, 20, 30, 40, 50% in some cases, depending on how bad it's run. So at a period of time, you've had operators that literally said, well, when we bought in 2020, 21, 22, we're just not going to put any money into the repairs. We're going to get, and this is one thing that we've seen a lot of, is we're going to have contractors come out and fix things, but we're not going to pay them. And we're not going to pay maybe our management company. Maybe we're just going to pocket the rent and see how long we can lie and kick the can down the road. Because I've seen apartment complexes that have had millions of dollars in mechanics lien filed against them from construction companies coming out and upgrading it, and then people not getting any relief on the rent because of that, or people stopped paying rent because of COVID and they never were really forced back into it, because that would require the owners to hire quality management company to go back and collect the rents.
And I think you're the point that you just made is brilliant. Let me tell you why. What was it Malcolm Muggeridge said? Posterity will look back on these times and marvel at the incredible credulity of the accounting profession, regulators, lawyers who represent these funds, and how they could be hoodwinked into this nonsense. And I'm going to tell you something else. You made a very good point. The same requirements to become a Reg D multifamily real estate promoter are for carpet cleaning.
Yeah.
Which is which is the only reason I went into business because I don't know how to do anything. So that was the only thing I could qualify for at age 16. My point is that it's easy entry, right? So
Yep.
if you look good in a suit and you look like, you're whatever, and the right vernacular, you can kind of finesse your way into and have one guy as your partner say, I have 20 years of experience because he's got 19 and I got one. It's all bad, but that's the least of it. But it's easy entry running these buildings. You mentioned, look at Florida with competition, what it did. And there's
Yep.
some Reg D promoters out there that just got, maybe had the initial success in 19, 20, and 21, and then everybody came
Mm-hmm.
because of,
Yep.
not just because of the newness, but because of the sheer number of people. So you make some great points. But Scott, one of the things is that you do that's so helpful to me, who's not as knowledgeable as you are. I mean, your cumulative examples are an eloquent, factual rebuttal to the hype that is the Reg D multifamily narrative that sadly, according to back to Craig McCain, between 2001 and 2023, 6.1 trillion with a T raised in Reg D offerings. Not all fraud, of course.
Right.
We're
Right.
not prone to hyperbole, but a lot of it is. But that's the number. That's more than public offerings. And I can't even begin to tell you the victim impact there because you're looking at sources and uses of cash. You're looking at everything from legitimate reasons to lose money. Look, brother, if I had a Reg D multifamily building that was a cash cow like these claim to be, 17 to 22, double your money every 3, 4, 5 years, I would hire 3 accounting firms to get 3 audited financials and say, you're lucky you're in. I really don't need your money. Here's
Yep.
the independent proof of profitability. Even though I'm not required, I have the goose that laid the golden egg, that generated. That's the impression. These things are, we're going to upgrade them, manage. Same story all the time. We buy distressed properties. They don't tell you that they pay double retail because they got to keep the Ponzi going. They actually say they buy under market, material misrepresentation. The government's going to come back and say, well, Barry, that's not, a needle mover criminally. I said, I'm just getting started. And then you go to the next step to your point about projections. They know at the time, watch this, that the company as a whole, even though they open new LLCs to own the buildings, that way they don't have to disclose the debt. By the way, they file separate tax returns. That's a trick I learned the hard way and got embarrassed by the government, by the way, for not knowing it, but I learned it. And life's a great teacher, isn't it, Scott? You get the lesson afterward. You get the test first and the lesson afterward.
I've always learned more from my mistakes and deals that went south than the ones that were home runs. And when things were,
And it's all bad from projections. And then, of course, you read the risk factors and it looks like this is a rat hole. You're going to lose your ass. And then the lawyers are like, we have a good conscience. I said, compare your social media ads, but suing that way doesn't work. Nobody cares.
Mhm.
So we move to hard fraud only. If I can't give the government absolute proof of hard fraud, not arguing over a disclosure requirement, I'm not going to beat Greenberg Tarek in the disclosure contest of what is material, what isn't. I'm just going to have to show that they represent a company that didn't disclose that they're hopelessly over encumbered, insolvent, and over $250 million upside down. And had they spent about $80 on title reports, they would know too. And at $1,200 an hour, they certainly had the budget. This is all bad. And that's
Mhm.
just one. And you can go on and on. Run the independent proof of profitability. In the case of Reg D, you now have to find smoking gun evidence to get the attention of regulators. And here's why. They are safer waiting for Nightingale to implode because there's no risk. But to be proactive, to go look, let me give a perfect example. Uh, please do not think this is at anything other than a factual statement because certainly more people that were involved deserve more credit than me, and yet I received credit I didn't deserve. But there was a letter from the FBI that we have where it says in a 27-month period between 2000 2003 and 2005, 13 cases over $1 billion we uncovered. Well, it was then you could probable cause, sources and uses of cash. Normally and regularly, the industry doesn't generate these returns. They're double pledging their collateral. They're over encumbered. Boom, they'd act. Today, you couldn't get 13 cases. I mean, I'm talking about they're done. They write in the letter, 27 months, 13 cases, and of course, 60 Minutes did a thing on it. But and there were many people that helped that deserve far more credit than me. My point in making it is that's the difference. The people I worked with were amazing. I'd walk into the FBI office and say to the supervisor, "Here's the offering." He said, "Okay, go to the thing. Here's the tape recorder phone." They gave me a phone that tape calls when it wasn't on. And he goes, "I want that thing back here because I got to transcribe it and give a reason why I gave that to you." We'd have case after case. It was today. They're scared out of their mind because they're going up against lawyers that they want to work for later. They're going up against lawyers that are resource, that deeper, a lot of deep pockets. There's trillions at stake. We already established that. You think we're the only ones that can run a title report? You think we're the only ones that could show sources and uses of cash and cross collateralize garbage and double pledging, triple pledging, quadruple pledging of assets across different companies, all claiming 100% value? And the accepted response is everybody does it, Scott. Everybody does it. And you know what? You don't know what you're talking about. Let me just give you one final comment. On the record, I had a favor a reporter owed me in Florida, who I very much love and respect. I said, there's a company in South Florida tied to it, Reg D, multifamily, tied to a family office, and they have $1.7 billion in assets. I said, I think they're full of it. He goes, I'll write them. I go, you going to do a story? He goes, probably not. My editor won't let me. Proactive fraud. We don't do it. And he goes, but I'll do this. They wrote back and they said, yes, we list 1.7 billion in total assets. He goes, they wrote him back and they admitted this. But that includes every deal we've ever done, driven by, bidded on, you know what I'm saying? Meaning, what accounting methodology that can textbook, FASB, GAAP, GAS, AICPA, state CPA, can you cite that allows you to cite on your relied upon, because they don't have financials website, that you own something that maybe, and by the way, they didn't anyway, that you owned 4 years ago and you're putting it as a current asset. It's all bad. And it's typical of the apathy of, and until these people sadly lose money, and I don't want that to happen, I want regulators to act and secure the assets, and now they're largely over encumbered, but whatever. Does that make sense? I hope.
Totally makes sense out there, because it's just the point being, they're like, well, we'll get to it, or it's common practice. I don't get it. It's still, if you raise money from investors and you're promising them a 10, 12% return, and you're basically, as you just said, committing complete fraud, saying you own a building, but you don't own it anymore. I don't know where they get to. I know. Actually, Barry, I just remembered the accounting term for that, not GAAP accounting. It's called MIU accounting. You know what MIU stands for? Make it up. Okay.
Yep. It is.
But that's the thing, is that and I love it what you're doing on your fraud minute stuff, talking about, and everybody's seen the 14% return on your money and all these flashy ads.
They know at the time that they can't achieve that, Scott. This is the government. The government's pushback is, yeah, but they qualified targeted. No, they know the debt. They know it's hopeless. So for them to say one word about revenue recognition into the positive or returns when you're 2.5 billion in debt, what is the debt service on that, brother? And it goes below the line with book value, but it doesn't go below the line with, we're going to stop making disbursements to investors, to how we started off the show.
Yeah.
Your brilliant point. I'm grateful that you made that point.
Let me ask you a question. I'm sure folks that are listening or watching this. How did you get hired by the FBI to dive into this originally? What's the background story?
So what I can talk about is NRIA. Another example of me being lucky and not good. It was, I had just gotten out of prison in 2018. I kept hearing these commercials nationwide, prolifically, 18 to 20%. So if you Google Barry Minkow, NRIA fraud, it's a $650 million case. Last week, the guy got sentenced to 12 years last week. So I got a lot of calls. I was working while I was on probation at a emergency homeless shelter in North Hollywood for Hope of the Valley. And lo and behold, I saw these commercials. I'm like, I'm going to write this thing up. And it took me 3 months or 4 months. And all I had was a laptop. And I did, irrational ratios, Scott. Normally and regularly, people in this industry don't throw off gross profit margins. And here's 3 public companies to prove it. I did tested the business model. I had an investigator, Dave Pellegrinelli, who I absolutely love. We've done tons of cases before. And I said, check this guy out. He found out that the guy was misspelling his name by 1 T, Scatero. He's convicted now, so that he could hide his past fraud with the guy who was secretly running the company who got sentenced to 12 years. So there was unbeknownst to me at the time, there was another hedge fund in New York that was also trying to uncover it. They had some other evidence, but now we're friends and we have the same lawyer, but I didn't know. So we wrote it and got threatened by the company in 2021 when the article came out that I was a whistleblower. And then we had 5 other cases, Titanium Capital out of Miami, Zara Financial out of Los Angeles, Harbor City, the congressman in New York he was a part of that. I didn't know it at the time, and a couple others. So those successes, they just came and said, hey, would you help us with a particular case? If I mentioned the name, you would know. But and that case is like this much today because agent took me aside and said, would you check out this? And that company in Indiana unloaded everything. I couldn't believe what we found, and we haven't stopped. And it's been a tough year. So that's how it happened. And I hope I answered it correctly for you.
No, it did. It totally makes sense. They're diving into that now. The thing that I always like to tell people too is, first of all, trust but verify. Verify, verify, verify. If somebody puts something out there, make sure you verify it. Make sure it makes sense. Make sure you can actually see the stuff on the county record, run a title report, simple things that people just don't do. Unfortunately, it reminds me a little bit of that Steve Martin movie. Was it when he was the gospel minister in a flashy suit? Was it Keeping Up the Faith? Something like that.
And he had the ear, but yeah.
Yeah. It comes down to a lot of that stuff is that you just got to, if it sounds too good to be true, it probably is, ladies and gentlemen. And I always see this represented back with people when I'm talking to other investors, like, I'm asking, okay, what are you invested in? Oh, I'm a part of 2,000 units. Well, are you really? Oh yeah, I got 50 grand in this lump amount. That means I have 2,000 units. I'm like, no, you don't.
See, there you go. Right, bingo. Now, add to that social media. The letters that I've written to Meta to try to hold them accountable to policies and procedures that preclude, untenable return offerings, because a common thread to every case we submitted is social media. That's how they found out of it. It imputes credibility immediately to the deal. I don't know why. Even more so, I was on Oprah Winfrey twice back in the 80s, and I used that to defraud the auditors, much to my shame, because that imputed credibility, as if Oprah's executive producers audited my financials before I made claims on the show, right? No.
Right.
But there's this imputed credibility that comes with the social media ads, flashy, glossy, but it's what they don't contain that bothers me. So you can have a company today that has, let's say, 15 properties, 4 aren't paying investors. And the next one they advertise, they don't disclose, we're missing it on 25% or 20% of our, portfolio is not performing. Nope. You get assets. We have 2.8 billion in assets. Really? What's the debt on that?
Yeah.
You get to cherry pick the good news and materially withhold the news that would impact a person relying upon your financial condition to invest, knowing you're doing it to conceal information that would thwart their investment, which is a crime. It's no different than me. Here's what it is, Scott. Lie about what you owe, earn, and own. That's all white collar crime is.
Mm-hmm.
Lie about what we owe, we conceal debt. We lie about what we earn, we jack IRRs. And that's, by the way, instead of selling a property, we refinance it, throw debt on it, never let it leave our thing, and then we book it as a sale on our historical. I call that round tripping. In accounting, it is the biggest round tripping fraud, and I have yet to hear a CPA say it. So I said it on the record in TCRs. This is round tripping. When you control the asset, you're the buyer and seller. Well, what is that? What they call, it's not refinance, they call it something that they do with the building. And all it is they just change LLCs, throw debt on it, pay investors a few bucks, pocket the rest, and jack the IRR, which is valuable to raise money. It's all bad. It's round tripping. And the regulators are like, well, yeah, but we're busy and you don't want to be me.
No. Well, there's a story came out last year about even the largest company out there right now, BlackRock, who had
Craig's
two big single family rental portfolios that weren't performing, that were crashing. And what they did is they just canceled those offerings and rolled the amount into their blind fund, which completely wiped out so much private equity of people that invested into it. So they're like, oh, we're losing money. We're just going to take it in here and not let you see what we're doing anymore, which I just
so
like.
Arbor, wasn't it Arbor who just wrote off? Now, did you cover this? I heard it from you. 450 million at 70 cents on the dollar. It was there was a lender third quarter 2000.
Yep.
And,
Arbor's selling their stuff off at 50 to 70 cents of what's owed on it to try to offset that off because they're not getting paid on their debt. So they originated.
But you look at the social media ads. How do you reconcile that? And regulators are like, when do they say enough's enough? You can't have two contradictory views existing simultaneously. It's called the law of non-contradiction. Either the Kansas City Chiefs or the San Francisco 49ers, not both. So one won the Super Bowl, one didn't. You can't have a collapsing in subcategories and cap rates and what you're doing every day, noting the public record of defaults, and still have the social media ads that you see today destroying investors who naively, and I don't mean naively in a negative way, but I believe what the company says way.
Yeah.
And they're getting wiped out. And it's very disconcerting. And I'll tell you something, what changed my life, Scott, and then, I know I've gone too long and please forgive me, and I appreciate the time, but there's a guy who was part of the one of the cases that you'll read about. I can't even mention the name, but you'll read about it soon. It's a promissory loan note fund, not legit guys do. And he's a fireman in the state of Arizona, and he called me and he said, "Listen, I read your report. Somebody released it online. I understand you uncovered this fraud." Well, whatever. I guess I was a little late. He said, "Listen, do you have a minute?" And he said, "I'm a fireman for 24 years in this town. And I have 4 kids and a wife, and I lost 400 grand in this deal. I promise you, Barry," he said, "I just was believing what he said. And I just feel like a complete failure." Mm-hmm. So I said, I'm going to have to pull my car over. And it was kind of at that point where I said, it isn't just, it can't, if you want to help people in this horrific sector, it can't stop at the uncovering stage. You got to figure out ways to get them their money back. And that's kind of what you do by just giving the facts. Think about this. Don't do this. Easy to give your money, hard to get it back. And when they lose it, I said, "Brother, you are not greedy, nor are you dumb. Here's the problem. You know how much money this guy spent to fool you? You know how much money I spent on to defraud the auditors? Scott, $1 million buying buildings and this and that to make it look like we were doing restoration work that we weren't doing. Do you know how much promoters spend to defraud investors? It's a lot of money. So you're not dumb. And by the way, even if you are, the penalty for that isn't you get to lose your life savings. So,
right.
Okay. So here's the deal. You're just not a liar. Now that's why you have me. So I'll check it out for you. And being a professional, my wife tells her friend, she goes, "My husband lies for a living, and then he brings his work home." She thinks she's such a comedian. So the point is that you're outmatched because you're not dealing on a level playing field. So what you're doing, I applaud and I'm grateful for, my friend.
I appreciate that. Now, Barry, can you shed a little insight how you got in trouble to begin with, a little bit of your background? I mean,
Oh,
I'll
yeah,
put a
yeah.
link to
So
that, but for those that are listening, you haven't heard
yeah,
yet.
yeah. So yeah, yeah. With the two quick things are, one, 16 years old, started a carpet cleaning company. By the time I was 21, I was involved with the mob, two New York crime families. If you Google, police learn how mob moved in on Minkow. But I went in voluntarily, and securities fraud, insider trading, all that, 26 million victim impact, 25-year sentence under the old law. Did
Mm.
7.5 years, was out 16 years, which means, Scott, that after 15, you're clean. And then was convicted of insider trading after pastoring 14 years at a church. And the crime there was the betrayal, not just to my family, obviously, but to the church, who had stood by me, loved me, cared for me. But um, I did another 7.5 years, and a large portion of the congregation forgave me. That was great. But didn't get away with it. But the second offense was really a first offense again because I was out for 50. So the judge, by the way, she was an absolute doll. Florida, Miami, Mr. Minkow, you're a first-time offender, but I know the truth about you, young man. And then she said, "I'm reading a letter from the SEC saying you uncovered all these frauds, and now I'm reading a letter saying you did insider trading from the same department." And she said, "Listen, you're going to get out of prison, but do me a favor, stay away from public companies and help people by just, you clearly have a talent to do this. Stay in that area." And she checked on me, Scott, in prison. My counselor called me in Atwater one day. It was like 5, 6 years in, and I was a year and a half from going home. She's like, "Your judge called to see how you were doing and asking if you were behaving." It was great. So no, the point was, is I got hammered. I deserved it. And the problem with the second offense was, these people at this church were the most wonderful. If I would
Mm.
have went to them and said, "I'm struggling with affairs," or, OxyContin addiction, which I was, but that's not an excuse, they would have helped me.
Hmm.
I'm struggling with finances. I wouldn't have had a commingle to support the. So I thought right equals forward motion, because we were uncovering fraud and wasn't getting paid. So that was a good thing, though. So if I borrowed and paid back on credit cards, all bad. So compromised my integrity, betrayed a wonderful group of people, Scott, the best of the best. But uh, listen, we don't have a God of a second chance. We have a God of another chance. And I'm
Yeah.
grateful for that. And I got my wife and family back, and many from the church are huge supporters, which I'm grateful for. So I hope that answers the question.
No, it totally does, and that's the great thing. The America loves a comeback story. We love an underdog. We love seeing people overcome great obstacles, even a lot. Most of the time, it's our own obstacles we put ourselves in front of.
Right? I think that's a great point. My greatest wounds are self-inflicted.
Yeah, yeah, and that's the thing I think that really struggles with those out there that are operating, that are hitting tough times, is the ego side of things. Is that we can't admit that we look bad, or we can't admit that we're doing something wrong. I have a buddy in Houston who's had a couple of deals go south. But what he has done, he has gone to his investors and say, "Hey, we've got a couple of deals with these deals that have gone south. Full disclosure, here's where we're at. Here's what we're working to
That's a
overcome that."
great guy right there.
He's a great guy right there. And it's not an easy thing. And he called me up because I'd gone through a couple bad deals. I said, "Listen, just you'll find out who your friends truly are. Just be honest. Stay off of socials, because everybody's going to think that if you're driving a Lambo online, they think you got a ton of money, right? If you're, and we've seen this, there's another big thing going on. If you're a minister driving a Lambo, but your staff can't pay their bills, there's something wrong with that too. You know what
Right,
I mean?
right.
But just disclosing, telling what's going on. Most people, they understand that shit will hit the fan from time to time. And what they want to know more so than anything, okay, what's your plan B, plan C? And the big mistake that a lot of people make is they don't disclose that. They say, "Hey, we'll just double down. We'll raise some more capital. and that turns into the Ponzi scheme of robbing people
Because
to pay Paul.
and that's it. Because Scott, I have never uncovered a fraud, met anybody in prison who didn't have a cure, which
Right.
means James Lewis got 30 years, $300 million Ponzi scheme. He was one good trading a day from getting it all back. Nick Lesson, I always tell accounting classes to watch Rogue Trader. Why? He lost $1 billion, Barings PLC, but he was always one good. That's how you sleep at night.
Yep.
I'm not the only one. I'll get it back. That's what I did. I'll pay off the mafia, the Ponzi. I'll go legit at ZBest. I'll merge with Keyserve. Milken will raise 40 million. I'm already public. I can get out of this. And the irony is we con ourselves into believing that cure. Madoff, another great example that the skin of the truth stuffed with the lie, the lipstick building floor 18 and 19 legit, skin of the truth. We did carpet cleaning, right? There are buildings in Reg D, but floor 17 you needed to sneak into or have access to. That's where the fraud was. That's the stuffed with a lie. Stuffed with a lie equivalent in Reg D real estate is the material non-disclosures of we're losing our we borrowed without your consent. The assets are over encumbered. We're doing everything we can to survive. The assets are worthless. The places aren't running well. We've cooked the books on performance, and it's all going to be okay somehow. And we're not the only ones doing it, so we can live with it. And it's a lie. Instead of what your buddy said, look, hey, there's no crime in failure. When Madoff lost his first, this is the only reason I watched that cross-country trip. He had the lady said his dad bailed him out in 62 of like a $30,000 loss. He could have chose liar or failure. And he chose the liar. But when you choose liar, you end up getting both. Instead of failure, all right, let's rebuild. But that was one of the best points I had ever heard, because every day, and you're in this world, when you're handling other people's money and you're lying to get money, you've chosen liar. And that's what all these ads are, lying to get money. What did I do? Lie to get money. If you want to boil down fraud to what it is, it's lying to get money, and it's lying about what you earn, owe, and own.
I love it. And that is where I think we need to call. That's a great way to stop the point here.
And I'm sorry I'm in this hotel. Forgive me.
No, all good. Where in the country at right now, Bear?
So San Diego, and then I'll be back in Nevada in 2 days.
Very nice. Well, have a good time in San Diego, as we call it.
Yeah, but it's work. But yeah, thank you. Good. Thanks for having me, brother.
Not a problem. Where's the best way for our listeners and viewers here to track you down?
Listen, at Minkow_Barry is Instagram, or just 1 minute on fraud, all one word, on TikTok. We do the fraud minute. It's free. We don't sell nothing. And try to do what you do, brother. Educate for free, level the playing field. And, we're not selling anything. I'm not running no Reg D fund, and it's all good. But thank you for having me.
Honored. Thanks for having me. Should have been working on each other's schedule to get you on here. So glad to have you on here, buddy.
An honor.
Thank you so much. And if I don't talk to you before Thanksgiving, have a great Thanksgiving too, Barry. All right?
Brother. Love you, Scott. Thanks.
Thank you. All right, guys. A lot of stuff to unpack in that episode. We'll throw in some links to some articles and some things that Barry mentioned on the episode here. But as always, when you're thinking about doing a deal, and it's not going to be a deal that you're managing, trust but verify. Make sure that they own the asset or have control of the asset. Make sure you understand the exit strategy. One of my mentors years ago told me only invest in things that you know and understand. And that's where people lose your shirt, is when you start investing in things that you have no clue about because somebody else said something or sounded good on social media. That's where you can lose your shirt and lose more than your dignity.